Hi, welcome to the CFRA webinar. I apologise straight away for the slight delay here with a technical problem getting started with the internet, so we'll crack on now. This is the CFRA Non-GAAP Metric webinar, when good information goes bad. My name is Giles Flower, Head of Global Institutional Sales at CFRA, and my colleague Emily Grant-Turner is going to be the main presenter today. She's a Senior Consumer Analyst with CFRA. She'll be going through most of the slides on the non-GAAP metrics. Just a quick bit of housekeeping before we get into the slides, to let you know that today's session is going to be recorded, and a link to the recording will be made available in the next few hours. During the session, you may also submit questions using the GoToWebinar panel, and we'll do our very best to answer as many questions as we can before we get to the end. Right, quickly run through to the agenda. A couple of slides on. Right, the agenda today is going to be fairly straightforward. I'm going to quickly run through an overview on CFRA. Some people will be familiar with us, some people won't. Just hopefully be some information on people who do know us, and some other parts of the service that they're less familiar with. Then Emily will be running through the non-GAAP metrics. That will include four main sections: operational adjustments, purchase accounting, EBITDA and cash flow, and what to watch for. And then after that, the slides will run through any Q&A questions we have at the end. We move on to a bit of background on CFRA and our history. From the forensic accounting side, the service has been around for 25 years, actually founded in 1994. In Washington, DC. It's changed ownership a few times. From the forensic accounting side, we were part of Metrics, which was then acquired by MSCI. And then now ownership of the firm acquired the business in 2013 from MSCI. 3 years later, 2016, we then acquired the S&P Equity Fundamental Research product, which is with part of our products now. And then just this year, we actually acquired First Bridge Data, which is a leading source of global ETF data. So as we stand today, CFRA, we're one of the largest global independent research firms, and we are totally employee-owned. So move on to a bit of background of our research. Our kind of mission is to provide clients, kind of help them make better investment decisions and business decisions on investments effectively. The forensic accounting side, we are looking to kind of highlight and find companies we think are masking business deterioration through aggressive or creative accounting. We're effectively trying to find companies that are playing games with their accounts and flag these companies on the negative side. These will then, the concerns on these companies will help investors from the risk mitigation side of things, and not only investors to avoid companies that are going to blow up, as well as some of our clients will be looking to invest on the short side, where we've got a good track record for alpha generation, for short idea generation. A couple of other products we also have, as well as the forensic accounting. We got a legal litigation product called Legal Edge, and they look at different aspects that fundamental analysts will not be looking at, and attend live court hearings, and produce research on a positive and negative side from the legal perspective. We run bespoke services and bespoke research that can be portfolio risks, and looking at a client will send a portfolio to us, and we do an analysis on the risks within the portfolio. We do tailored work for clients on stocks of their choice, where we look for the forensic accounting concerns within those companies on a due diligence basis. We make the research we provide available in a library as well, for people who may want to see what other research has been done on other companies. We also provide seminars and training. If we move on to the next slide. As part of the services I just mentioned there, we run an advisory service, which is kind of tailored into what we're doing here on the webinar as well, where we will look at industry standards and provide educational research and also providing an accounting help desk to our clients. So we use work as an accounting expert. So if a client's got any issues or concerns on a regulatory side, or a change of disclosure, wants some clarification on something, then a client can come to us and we'll walk them through the concerns or changes or issues they may see from going through the filing. As I mentioned before, we do custom research that can be on any company anywhere. As well as we obviously, the forensic work is looking at active ideas that we generate where we find ideas ourselves. We also provide training, seminar training, where we can come to clients' offices and run through some issues and red flags you should be looking for when you're going through the company's filings. Lastly from me, on to the next slide, we do track our performance and run effectively a biggest concerns portfolio. It's not live run, it's just a kind of effectively dummy portfolio. Been tracking this for many years, especially in North America and Europe. And these charts kind of highlight the track record we have of effectively excess return or alpha generation, which is the kind of the bluey-green bars you can see running up over the time across the 3 different regions that we cover in North America, Europe, and Asia. So we're proud of our track record, and hopefully gives clients comfort that we are kind of flagging companies you should be avoiding, or flagging companies you can make money from the short side. I will now hand over to Emily for the bulk of the slides on non-GAAP. So over to you, Emily.
Thanks, Giles, and hello to everyone on the line. Let's talk about non-GAAP. Historically, the idea of providing non-GAAP metrics has been to allow investors to see past one-time or non-recurring items. Here are some of the most common below: restructuring charges, impairments, amortization of required intangible assets, integration costs, stock-based compensation expense, pension expense and income, and debt repayment costs. As you can see, these adjustments are quite common. Over 2/3 of S&P 500 companies had some sort of adjustment in fiscal 15, with the most common being restructuring charges. 1/3 of the companies reported these. We think that analysts are not showing enough skepticism in valuing companies off of these metrics. Companies are including questionable items in their adjustments. They are changing their business models to match the metrics, and they are subtly changing the metrics. Here are the key features that we think makes a non-GAAP adjustment a good one. It has to actually provide useful information to investors. It should clarify what is going on in the steady state of the business operations. It must be presented consistently across time. Gains and losses have to be treated equally. Expenses that are just part of the business model don't qualify. And it should include details so that outsiders can assess the validity of the exclusions. Now let's talk about operational adjustments. Restructuring expenses, again, are the most common. Our concern is that companies typically do not provide enough detail to assess the validity of the restructuring charge. If the company is restructuring every quarter, it begs the question, is this company just in the wrong business? Stock-based compensation expense. Proponents of excluding stock-based compensation expense from operational metrics claim that it is non-cash and that the cost of options is reflected in dilution. We think this argument is problematic because only some of the dilution is captured in the diluted share count. This is because the treasury stock method calculates dilution off of today's share price, not the future price of the shares. Since we typically own stocks because we think that the share price will go up, this results in an underestimation of dilution. Let's take a look at an example, Salesforce.com. We can see here in the third column that stock-based compensation was the most material add back to Salesforce's non-GAAP earnings in fiscal 16. We see that stock-based comp was 88 cents of 75 cents in total fiscal 16 non-GAAP earnings. CRM provides an adjusted diluted share count, which they have to do because they generate GAAP losses, but the share count only captures day one dilution. Now, since CRM was trading at about $69 a share at the time of the 10K, the options that were circled in red were not captured in the calculation of dilution. We estimated that the treasury stock method for stock options resulted in approximately 5 million shares of dilution. However, most of those options are likely to be exercised in 2 to 5 years, so we would expect the price of the stock to be significantly higher. So fewer shares would be able to be repurchased at that point in time. If we use an expected price at option expiration to calculate the share repurchase level, rather than the current price, expected dilution more than doubles to 13 million rather than 5 million. On the other hand, Broadcom does things correctly. So to sum up this section, our position is that either stock-based compensation needs to be fully reflected in the adjusted diluted share count, that is, the numerator has to match the denominator, or that analysts can just keep it simple and consider the stock-based compensation expense as compensation expense. Now let's move on to pensions. There are 3 main types of pension adjustments: adjustments for curtailment, for accounting estimate changes, and for marks to market. In our opinion, all 3 adjustments may be acceptable. However, we have some caveats here. Accounting estimate changes, we found, are only typically provided when the estimate goes against the company. And even though we are generally in favor of accepting pension curtailment adjustments, management teams can still play games with these. As an example, we look at Oshkosh. We noticed in 2014 that Oshkosh was treating pension curtailments inconsistently. Oshkosh included 1.8 million of net pension curtailment charges in the first half of 13, but they excluded pension curtailment losses of 4.1 million in the first half of fiscal 14. Management told us that they evaluate how to treat curtailments each fiscal year, and then they use that approach for the entire fiscal year. Now, this explanation is completely ridiculous, since year-on-year comparisons are sort of important to equity analysis, but that approach didn't last very long at all. In the third quarter of 14, Oshkosh included both the gain and the loss from non-GAAP earnings. Treating the gain and the loss equally is appropriate, but the company's rapid changes in policy within the span of the year is pretty shocking. On to inventory write-downs. I generally accept these if these are one-time, but watch for situations in which companies are either under-provisioning for obsolete inventory in the quarter preceding the write-down, or companies that are over-purchasing in the quarters preceding the write-down. Litigation expenses. If the gains and losses are truly one-time, then we are in favor in backing these out. But again, you have to ask yourself, is litigation over products just a part of doing business, like for financial services or multi-level marketing? And again, you, the investor, should ask yourself, is the company treating gains and losses equally? AECOM did not back out favorable adjustments from acquisition-related projects and legal matters in the December 2015 quarter. These favorable adjustments were 7 cents of non-GAAP earnings, which was more than all of the 5-cent beat. Although impairment charges represent a real economic cost, in our opinion, the deterioration in the asset has often been reflected in the accumulated deterioration in the economic value of the asset or in changes external to that asset. So we just usually back these charges out. Acquisition expenses. If these expenses are truly one-off, then we recommend backing them out of non-GAAP earnings. But if the business model is built around M&A, then these costs are just part of the business. Now for some thoughts on purchase accounting. Gains associated with bargain purchase price should be backed out, and watch for companies that don't do this. For the step-ups and step-downs of assets and liabilities, we do recommend backing out these fair value adjustments. since these adjustments do not reflect the underlying economics of the business. Now for contingent consideration. We recommend making adjustments related to re-estimation of contingent consideration liabilities in all cases, as the changes in the liability do not reflect the run rate of the business. But what happens when a company does not back out the gains associated with the revaluation of the contingent consideration? In the case of OSI systems, consensus estimates look much more difficult to achieve absent the gains from the contingent consideration. Now, this chart at top shows the contingent consideration revaluations for each quarter as a percentage of adjusted operating income and as a percentage of non-GAAP EPS. The bottom chart here shows consensus expectations versus first reported non-GAAP EPS, which includes the gains associated with the revaluation of the contingent consideration, and as a percentage of the bottom chart shows consensus expectations versus non-GAAP EPS. So consensus expectations for 4Q17 imply year-on-year growth of 64%. And then the bottom part shows it versus non-GAAP EPS with the gains and the revaluation backed out. Now, when we back out these non-operational gains, we see that consensus expectations for the fourth quarter of 17 implies earnings growth of 185% year-on-year, so quite different. This example serves to illustrate why non-GAAP adjustments, when properly done, can be truly helpful to investors. We think that investors should consider the amortization of acquired intangible assets in all cases. In our opinion, the amortization reflects the expense that otherwise would have had to hit the income statement as R&D expense. This is particularly true if the business model revolves around acquiring technology. And an example of purchased intangible amortization, and just about everything else that we've discussed, is a little company called Valiant and the magic of cash earnings, or how you can take 6 cents of GAAP earnings per share for the first half of 15 and grow that into cash earnings of nearly $5 per share. Now let's talk about common adjustments to EBITDA and cash flow. For our discussion of EBITDA, the main points to keep in mind is that EBITDA by definition does not capture capitalized expenses, and it does not capture changes in working capital or taxes. Since EV/EBITDA ignores capitalized expenses, some investors subtract CapEx from EBITDA. The downside to this approach is that it only captures the capitalized expenses at the time of the cash outlay and thus penalizes growing companies. Likewise, for maintenance CapEx, capturing the expense at the time of cash outlay may provide a distorted view of the company, especially for growing companies. Also, on a more practical note, many companies don't distinguish between maintenance CapEx and growth CapEx. Taxes and EBITDA. In our view, taxes are a real cash cost that is never captured in EBITDA. Now, the topic on this slide is a little bit more arcane, so I'll just give some background here. Many companies, particularly in the industrials sector, sell their accounts receivables to banks in order to improve their cash conversion. These sales can take two forms. Either an outright sale of the receivables for cash, with the bank taking a haircut, or receivables can be securitized. These cash sales take place when both the customer and the company have very high credit quality, while securitizations are used in situations where the credit quality is more varied. This is because investors with different risk appetites can purchase different tranches. Proceeds from both forms of factoring were included in CFFO for US GAAP reporters up until 2017 when the US GAAP accounting rules changed. Now proceeds from securitizations are reflected in investing activities. We are almost always in favor of adding back the proceeds to cash flow from operations since we do not believe that the form of financing elected by the company should determine cash flow from operations. We also do not believe that the credit rating of either the company or its customers should impact cash flow from operations. And now, for the second and last time in this presentation, I'm going to say something nice about a company's non-GAAP adjustments. T-Mobile does this correctly. We can see here that they start with GAAP CFFO and add back CapEx and then add back the proceeds related to the securitization. So do we think that GAAP CFFO growth of 74% year on year in the second half of 19 was representative of the company's growth? Or do we think that the adjusted CFFO growth of 19% was more representative? My vote is definitely for the adjusted CFFO growth. But a lot of non-GAAP adjustments that we deal with here at CFRA do not fit neatly into the above buckets. In this section, a common theme that we'll examine is a lack of information on non-GAAP adjustments provided to investors in the earnings release, which is, of course, what moves the stock. In the second quarter 16 earnings release, we saw that Syneos Health backed out restructuring charges, which were 2 cents of earnings. Now, non-GAAP EPS of 61 cents beat consensus by 3 cents, so this is significant. In the 10Q, we saw that the 2 cents in restructuring charges were related to redundancies of 20 people, which was about 0.3% of the company's total payroll. Are these kind of layoffs really unusual or one-time for a company that size? We can also see games played with KPIs that are intended to measure customer interest. Carvana has a KPI, average monthly unique visitors, that measures traffic to their website. Since Carvana is an internet retailer that does not have an app, this is a pretty pure indicator of customer traffic. Now on this slide, we have 2 quotes from the company saying that this is an important metric. But in the second quarter 10Q, the company disclosed a change to how this KPI is measured in the MD&A. We were able to back into the lift from the new definition, which provided eyeballs that were 8% higher in the December 17 quarter and 9% higher in the March 18 quarter. Now, we think that in the case of a definition change of an important key performance indicator, the company should provide a clear explanation of the change for investors, and they should also provide 8 quarters of prior comparable data when the new definition is introduced. Let's look at another example. Pandora, the jewelry company, operated in fiscal 16 with 3 different same-store sales definitions. Prior comparable data was provided for the first change, but not for the second change. Having so many definitions, especially without prior comparable data, inhibits an analyst's abilities to model and thus to appropriately value the company. Now on to Domino's Australia. They just presented an incorrect figure in their first half of 17 presentation that flattered their comp trend. In the first half 17 presentation, Domino's Australia put first half European same-store sales of 7.5%. We see that circled in red. But then in the first half 16 presentation, European same-store sales were originally reported at 8.5%. So in effect, this error softened the trend of decelerating comps in Europe that Domino's Australia was reporting. Triumph Group excluded a total of $313 million of program forward losses from its non-GAAP earnings in the March 16 and December 14 quarters combined. But then in the December 16 quarter, TGI reversed $37 million of the program forward losses back into earnings. Of course, this was not mentioned in the earnings release. Now over to home furnishings. Investors may wonder, What is employment-related expense at Williams-Sonoma? It appears to be different than severance expense, which the company called out in fiscal 17. See the bottom of this non-GAAP reconciliation on this slide. In the first quarter of 19, the nebulous employment-related expense was 9 cents, or 11% of management adjusted EPS. Luckily, an enterprising sell-side analyst asked such a question on the first quarter 19 call. And the answer is essentially, we can't tell you because it's too sensitive. This is not a good answer for something that is over 10% of a company's adjusted earnings. So Omnicell made an out-of-period adjustment in the fourth quarter of 18, which it mentioned in the earnings release but didn't quantify. When investors got to the 10K, it turned out that the out-of-period adjustment was 10% of fourth quarter 18 EBIT and 175 basis points of EBIT margin. Maybe this adjustment should have been given some more airtime than just a footnote in the 8K stating that it was non-material. So I've reached the end of my examples. So to wrap up things before we open up the line for questions, let's review again our criteria for what makes a non-GAAP adjustment a good one. It has to actually provide useful information to investors. It should clarify what is going on in the steady state of the business operations. It must be presented consistently across time. Gains and losses have to be treated equally. Expenses that are just part of the business model don't qualify. And it should include details so that outsiders can assess the validity of the adjustments. And now I'll open it up for questions.
Thank you, Emily. So it's Giles again. We seem to have 2 or 3 questions that we'll start with anyway, at least. First one is for you. Are there any shortcuts to non-GAAP adjustments, or is this just a very extremely manual process?
So I think it is a very manual process, unfortunately, which is what makes it so tricky. For CFRA clients, there are 2 main resources that we offer you to help with these adjustments. The first are the educational reports for accounting lens clients, and your account manager is a great resource for accessing those on the website. And the second resource is our accounting help desk feature, again for accounting lens clients, where if you ask me or one of the other analysts a question that's going to take less than an hour or 2 of our time, we're happy to help. This is included in the price of your subscription. And a lot of the really great questions that we get for accounting help desk do relate to non-GAAP adjustments, and I think that we're really additive to clients' processes there.
Thank you. Another one actually, Emily, on your securitization slides. And the question is, do you recommend making any other adjustments to CFFO for accounts receivable factoring?
Yeah, absolutely. This is a tricky topic, and it's actually another accounting help desk question that I get all the time. But so for outright sales, for cash sales of accounts receivable, you have to look at what the bank has outstanding at the end of the period and subtract that versus what the bank had outstanding at the start of the previous period. So when companies are starting up their factoring programs, they tend to get a big boost to cash flow from operations, because just think about it, right? You're gonna be receiving cash from the bank earlier than you would have received from your customer. So companies get a boost to CFFO when they start up a new factoring program, but then conversely, right? When they wind down an existing factoring program or make it smaller, like, let's say because rates went up, right, and it becomes a less attractive form of financing, then they face a headwind. So it's very important to adjust for these programs. Clients, please do lob questions our way.
That's great. Another question for you, Emily. Is any hope that the SEC or regulator will crack down on this non-GAAP adjustments?
Yeah. So the SEC did, I think about 5 years ago, they did start like a very public crackdown on non-GAAP. They announced it as one of their priorities, and I mean, I think they've done a really good job of cracking down. Many of the more egregious examples in this presentation, you'll note, were from several years ago. Companies have, though, gotten kind of more creative around kind of how they get around the system. I think that one of our Legal Edge analysts, Nick Rodelli, the head of the team, was an attorney at the SEC before he worked on the buy side as a special sits analyst, and then he came to CFRA. But he's given us some insight, kind of into the SEC. And I think the thing that you have to keep in mind, for when you're evaluating the SEC is that the lawyers who work there are working within kind of existing securities law and regulations, which does limit what they can do. And the other thing to keep in mind is just the number of companies that they have to regulate. So, while they don't get everything perfect every single time, I do think that they do a pretty good job. And it's one of the reasons I think why the U.S. markets, are such leaders in the world markets. So.
Okay, that's great. Emily, another question actually away from the US then. There's a question here. You did not discuss many Asian companies within the presentation. Any thoughts on non-GAAP games that are going on within that region?
Yeah, so we do see, disclosure tends to be a little bit less good than, say, European or US companies. So, that's kind of one issue. Another issue, particularly for China-based companies that we see, is that they'll often include government grants, in their operating results, and it's not clear to me, that that's necessarily indicative of the underlying, run rates of the business. The other thing that we do tend to see is that companies tend to, companies, when you consolidate an investee, right, say you're taking an investee from 20% ownership to 60% ownership where you have to consolidate, you'll typically either have a gain or a loss associated with the consolidation. And those gains and losses, like all other gains and losses, need to be treated equally. VIP Shops backs out the losses, but they keep the gains. But Alibaba, conversely, treats each correctly. They treat the gains and the losses equally, and in this respect, they're good citizens.
Okay, thank you. I got another question just come through. For companies with foreign operations, to what extent do you analyze constant currency revenue growth versus reported revenue growth? And have you found instances of companies playing games here?
Yeah, I mean, constant currency, that's a great question. I think it is, it's definitely an issue, especially for the kind of working capital analysis that we like to do at CFRA. Oftentimes companies will provide constant currency adjustments, maybe only for earnings and for revenues, but they won't provide it for certain balance sheet items. And, and that that kind of mismatch makes it can make analysis challenging. Hasbro is an example of a company that does provide the FX impacts on inventories, receivables, as well as revenues, which we think is an example, of the way that we think more companies should be doing things.
I think thanks for that, Emily. There's actually a question literally just coming through. Should advisory services defined as strategic investments be backed out of non-GAAP reconciliations?
Can you repeat that, please?
Sorry, should advisory services defined as strategic investments be backed out of non-GAAP reconciliations?
Okay, that's a good question. So I think that again, you have to ask yourself, is this really one time? Are such costs really one time? Or is this part of the business model? So again, for like say a company, for a company that's built its business on acquiring other companies, like Church & Dwight, right? They're constantly buying brands, and that's part of how they're growing their business. I would not back out such charges for a company like that. However, if it is a one-time event, then I would be more willing to back it out. Where you get into kind of a funny situation is that oftentimes you'll see these advisory services related charges backed out of the adjusted metrics that management teams need to hit to reach their compensation targets. And that's particularly, I think, egregious at companies that are built on, kind of doing M&A.
That's great. Thank you, Emily. I think so far that's all the questions we have. So does anyone else have any further questions? Please you can still contact us and get questions. We can still respond to you. Just drop us a message. You can contact us on cservices@cfraresearch.com. So letter C, services@cfraresearch.com. So on behalf of the team at CFRA, I'd like to thank you for joining us today. As a note, also, the replay to this will be available shortly, sometime later today, I believe. Please keep an eye on our website for any further webinars we may have coming up that could be of interest to you. So thank you very much. I appreciate everyone's time. Thank you.